Berkshire Hathaway trending today after the firm reported record earnings over the weekend, as well as releasing its latest 13F filing. The shares earlier touched a record. In his annual letter to shareholders, Buffett praised the 5 Japanese firms owned by Berkshire and noted raising his stake in the companies. According to FactSet, since announcing their investments in Mitsubishi, Itochu, Marubeni, Mitsui, and Sumitomo, the returns in yen of those five companies range from a low of 185% to a high of 402%. Our next guest today says that Berkshire is not alone in looking to Japan for some success. For more on an investing outlook, both international and in the U.S., here's Matt Miskin, John Hancock Investment Management co-CIO. Good to see you, Matt. I know you guys look at the U.S. primarily, but you look around the globe as well. And I just wanted to start there with what you were thinking with Japan, because it's not just those stocks that have been doing well. We've been seeing sort of unprecedented, or at least returns in Japan that we haven't seen for a long time.
Yeah, Julie, it's a good point. Japan's Nikkei looks like a crypto currency right now. It's just been going up this year, and it's one of the best performers, if not the best performer globally. The only things we would say as potential negatives, it is a consensus allocation. So when we talk to asset managers, broker dealers, research firms that we work with, that was the number one consensus call of 2024. In terms of how Japanese stock market has done so well, it's a bit perplexing, frankly. The manufacturing PMI is actually decelerated. The economic data doesn't look great. In fact, they're in a recession right now. And the stock market's at all-time high. Welcome to 2024, right? And so you're seeing actually weaker economic growth, but what they're doing is they're devaluing the currency. They're going to do QE, for quantitative easing, yield curve control, forever, perhaps. Because if they didn't do it, if they didn't tighten policy at the end of last year, I don't know when they're going to be able to do it. So there is tailwinds in terms of easy policy, weakening currency, but growth is weak, and it's pretty consensus. We like it internationally. We still like the U.S. more.
And let's talk more about the U.S., Matt, and pick it up there. I'm interested, Matt, how investors have clearly tempered their expectations for rate cuts, Matt, when and how many. Yet despite that, the markets continue to move higher. How do you explain that dynamic, Matt?
I try to come up with an analogy on this one, and I think the Fed basically called for picture yourself late night at a bar. I haven't actually done this for about 20 years, so I'm going off memory, and it's a bit cloudy, but nonetheless, when the bartender says last call, that was the Fed last year. So when the Fed said, "Hey, we're going to do rate cuts, we're turning more dovish," that was in essence telling the markets, this is the last call for a risk-on rally. And then as we come into this year, the bar's been closed. The Fed has been pushing back. So we've gone from 6 rate cuts priced into 3, and it might go to 0. I mean, actually, Treasury yields are up today. And so the economy's strong. Inflation's coming down, but it's not that fast. Actually, we're getting a bit of a resurging inflation here. So the fact is that the party's still going, even though the bar is closed. Usually when the tap is closed, the party starts to clear out. It hasn't. And so we do think that's going to be a headwind for markets. Is if the Fed comes back hawkish and we don't get these cuts baked in, it's going to be tougher for stocks than after this great start to the year.
Yeah, I also am reaching into the memory banks for this analogy, Matt. But, what is going to be the sort of catalyst, the realization? When is that going to hit the market that, they got to go home?
Yeah, it's just Treasury yields probably moving higher from here. And, housing has started. You talked to Greg last segment, just an awesome economist, and talking about how interest rate sensitive the housing market is. Well, housing data actually started to rebound to start this year. And if mortgage rates come back up because there's just so much risk taking and investors are pulling away from treasuries and going into, say, Bitcoin or something, that's going to cause treasury yields to rise. And then you've got this circular feedback loop where higher treasury yields weaken housing again. And then that causes a negative growth impulse to the market. So we're kind of still pulling off or drafting off of the decline in treasury yields, mortgage rates, and now they're coming up again. So I think basically, to simplify, treasury yields need to go up until something breaks. And until then, this market is probably going to be a momentum-driven market. And that risk is one, though, that could very well come about over the course of this year.
And Matt, another theme I want to touch on with you real quickly. I'm just interested, Matt, are you getting questions at all from your clients about whether we're now in some type of NVIDIA-led AI bubble? And if so, Matt, what are you telling clients?
Yes. And I love just answering the question simply instead of dancing around it. Yes, this is AI mania to some degree, and we like quality at a reasonable price. So we are in the stock market. We're overweight tech. We're overweight the U.S., but there's parts that are getting frothy, and there's parts that aren't as reasonable. But NVIDIA last week did deliver, and I mean, what a quarter! You just can't even draw this stuff up in terms of the growth rate and what just came off. But now that's the comps. It's what have you done for me lately in corporate finance? And really what we're seeing is these numbers are amazing. So now what are you going to do? You got to grow on top of that. It's going to be tough to do. So we are looking at that is still, I mean, it's a part of the technology sector. We're going to take that, but we are diversifying and looking at other parts of the market that are cheaper, less momentum driven, and they could get a rotation eventually if NVIDIA stops its unbelievable run.
Yeah, I mean, we asked these same questions last year when they first came out with that blockbuster forecast, right? How are they going to keep it going? They managed to keep it going thus far. I'm curious, though, if you can dig into a little bit more in more detail those other areas of the market that you're talking about that maybe we could see that rotation into. Where are those?
Yeah, high quality industrials in the Midwest are cheap. They're seeing a lot of fiscal spending from the CHIPS Act, the Inflation Reduction Act. These companies have high ROE. They were up 30% last year, mid-cap industrials, but they're still trading cheap. So they were the only thing we found that had that kind of momentum to it, but also the fundamental support and not that expensive. So that's one place we take a look. And then high quality bonds. I know, Julie, we've been talking about these and we were early to it. But these yields, again, if I could get 6% on a single A corporate bond on a pretty low volatility basis, that over the next 10 years could look pretty attractive versus some of the other parts of the markets here. So we are still looking at that as an opportunity. We think there's income actually in the fixed income market. So we want to take advantage of that too.
Matt, it was great to have you on the show today. Thanks so much for joining us.
Thank you.